The variable interest entity structure has caused some real nightmares for investors. In a couple of situations, the owner of the variable interest entity has decided that he doesn't want to follow the contracts that he has signed. And in a couple of cases, these things have been taken to court, and the public company has tried to enforce their rights under the contracts that establish the VIE. In one case, using a structure very similar to a VIE, the owner of the VIE refused to turn over certain dividends that they'd received from an investment in a bank in China. The China Supreme Court ultimately ruled that the VIE contracts were not enforceable because the VIE contracts were in contrary to public policy. That is, they were trying to do something illegal to allow foreign investment in restricted sectors through legal means, and therefore the contracts were not enforceable. Another case reached arbitration in China and also held that the VIE contracts were not enforceable. As a consequence, in both of those cases, the shareholders lost control of the VIE and lost the value in the company, which really rattled markets when these cases took place. The most significant case with respect to a VIE was with Alibaba. In 2011, Jack Ma took Alipay out of the Alibaba Group. The Alibaba Group was owned mostly by Yahoo and SoftBank, and Alipay was taken out because of fears that China would restrict the third-party payment processing system such that foreign investors would not be allowed. A settlement was reached between Yahoo, SoftBank, and Alibaba on how to deal with that, but it has caused great concern in the recent initial public offering of Alibaba and continues to trouble investors. The VIE structure is still broadly used in China. All of the recent IPOs of Chinese companies have used the VIE structure, and the reason for that is twofold. One, it's the only way to play the game. Right now, until China changes its rules for foreign investment in China, there is no opportunity to invest in these kinds of businesses without using the VIE structure. So it's the only way to do it. And investors are keen to participate in the rapid growth of Chinese companies and the great growth story that there is in China, and this is the only way to play the game. So investors so far have been willing to take that risk. They probably discount the stocks. They trade at a discount to what they would trade at if they didn't have these problems with the VIE. But nonetheless, investors have continued to invest in those stocks. There's hope on the horizon for reforms in China that would make the VIE structure obsolete. That would be a big win for investors in Chinese companies. At the third plenum meetings of the Communist Party of China, there were commitments made to reform the rules for foreign investment in the e-commerce sector and the education sector. Those are the two sectors that are most widely used by Chinese companies listing in the United States. If these rules are liberalized to allow foreign investment in these sectors, then the need for the VIE may disappear and the VIE structure may become obsolete. Chinese companies could be allowed to list directly abroad. That would be a very positive thing for investors because they would actually own the company that they're investing in instead of owning rights to a contract in the company that they're investing in. And it would be good for Chinese regulators because it would get them direct access to control these companies and to regulate them. So I'm hopeful that sometime in the next year or two we will see reforms to the foreign investment rules that allow foreign investment in e-commerce and education, which will mean that the VIE structure will no longer be necessary and the problems that are associated with it will disappear. One of the other problems with Chinese companies that have listed abroad is it's very difficult for Chinese citizens to invest in companies that have listings on the New York Stock Exchange or NASDAQ. The reason for that is that China has strict rules on foreign currency exchange. The foreign exchange rate is controlled. Individuals cannot readily transfer money into US dollars in order to buy stock on a US stock exchange. That means that most Chinese were precluded from participating in the largest IPO in history, Alibaba. With the Alibaba Group, when it listed on the New York Stock Exchange, the shares were not available for purchase by Chinese individuals who could not get US dollars to purchase them. Alibaba listed in the United States because China's stock exchanges were not ready for a listing of that particular size. And Alibaba had foreign investors, and foreign investors are not allowed to invest in Chinese companies. Liberalizing the rules for foreign investment in the e-commerce sector could allow a company like Alibaba to restructure itself into a Chinese company and seek a secondary stock listing on China's stock exchanges, which would allow the Chinese people to participate in one of the world's most successful internet companies.